had good time to network with speakers and other people. So we have changed timings of the sessions. This session is starting at 2:55 and it will end 3:55. After that, coffee break will now be for 15 minutes from 3:55 to 4:10. And the last session would be from 4:10 to 5:10. Okay, so moving on to the next session, which is a panel discussion on future of work in wealth management. This session will be moderated by my volunteer colleague Gaurav Kaushik. In his day job, he works as an associate director at Kotak Wealth Management. I would request Gaurav to please come on the stage. Friends, wealth management is going through a host of disruptions, regulations, new business models, technology, etc. There are a lot of questions around these disruptions. Will technological changes reduce the role of humans in the industry, or will these changes work as the enabler and bring greater efficiencies? Which business model will survive? To understand the impact of these disruptions in the wealth management sector, we have three eminent industry experts with us. I will now introduce our panelists one by one. Our first panelist is Mr. Rajendra Kalur. Rajendra is co-founder of Trust Plutus Wealth Managers India Private Limited and Trust Plutus Family Office and Investment Advisors India Private Limited. He has over 25 years of experience in financial services in areas of asset management, investment banking, wealth management, and insurance. Prior to Trust Plutus, Rajendra has worked with RBS NV, ABN AMRO NV, Wealth Advisors, ICICI Prudential AMC, DSP Merrill Lynch, and General Insurance Corporation of India in various capacities. Mr. Kalur is also a director on the board of CFA Society India in a volunteer capacity. Thank you, Mr. Kalur. Our second panelist is Mr. Ashish Kashyap. Ashish is the founder of IndWealth, an AI-based wealth tech platform targeting affluent and HNIs. Previously, Ashish had founded Ibibo Group, Go Ibibo, and Redbus, which he sold to Make My Trip in October 2016. He also co-founded PayU India, a leading payment service provider, in 2011. Before starting his entrepreneurial journey, Ashish was Google India's first country head. Welcome, Ashish. Our third and last panelist is Soumya Rajan. Soumya is the founder, MD, CEO of Waterfield Advisors, India's leading multifamily office and advisory firm. She has been recognized by AIWMI as one of India's top 100 women in finance in 2019.
And to the post-lunch session for the day, where we have a panel discussion on future of wealth management. We have a beautiful mix of panelists here, starting from Mr. Rajendra Kalur, who's got more than 25 years of work experience in the financial services and wealth management area. He's also a very active volunteer at CFA and has obliged us on multiple occasions on forums and platforms like these. Soumya, who's also spent a great amount of working life, more than I think 25 years in financial services, used to be CEO for Standard Chartered Wealth Management, and then went on to start her own advisory business by the name of Waterfield in 2011. And we have Ashish, who's been a serial entrepreneur, very successful at that, and has now ventured into wealth management with his latest offering by the name of IndWealth. So I warmly welcome all three of you. So as I begin, I'll just briefly introduce the wealth management industry for the benefit of all the candidates. We've been lucky to be in India, which is one of the fastest growing large economies. The wealth which has been created, especially in the last 15, 20 years, is quite staggering. And also the amount which is now starting to get into financial assets is rapidly growing year on year. The level of assets that we now see in the mutual fund industry has crossed 25 lakh crore. This number used to be roughly 8 lakh crore about 5 years back. So this number has jumped 3 times in the last 5 years. Similarly, alternate investment funds, which was a non-existent category about 5-6 years back, today is touching something like 2 lakh crores. So we have this rapid movement that we've seen towards financial assets over the recent past. So I'll start the discussion on this note with the panelists as to what they think is the future. Are we going to continue to see a similar rapid secular growth in the size of the industry in India? Maybe starting with Rajendra.
Yeah, I mean, thanks, Gaurav, and interesting question because what we have seen is, I think, very recently is some kind of a transition from our propensity to save in the physical assets and go and move towards financial assets. This is still a very recent phenomenon, and we still, I think, are not sure whether it's a structural phenomenon or a cyclical phenomenon. We have seen something like this happen in the 90s when there was a lot of flocking into financial assets, and then we have seen a disappointment post the 90s as well when people, due to various reasons, have reverted to physical assets. So it's not something, this is not a trend that we haven't seen before. But at the same time, I think what we need to look at is the policymakers' increasing thrust on the financialization and the fact that there is a great degree of formalization that is taking place, I think would mean that this could be a much more long lasting and possibly a structural phenomenon than just a cyclical effect.
I'm going to add a little bit more to what Raj mentioned, which was essentially around the fact that, and coming from a banking lens, a lot of people put money into physical assets like real estate because if you were a business and you wanted to borrow from the bank, the only kind of security that the banks recognized was real estate. And that's why you invariably found that most businesses and most entrepreneurs actually put money into real estate for that day when they may need to look at bank funding or otherwise. I think that was one of the reasons why we had such a predominance of real estate and physical assets that we took on board. The second change, which I think has also happened, which I'm seeing over the last 10 years, is that earlier promoters were always putting any money that they generated back into their business. It's only after, I think, this whole ecosystem around the private equity space, the VC space has come about, where people are now a lot more open to talking about issues around stake sales of their companies, actually selling their businesses. These are things which maybe 10 or 15 years ago, or when I first started my financial services career in 1994, people didn't talk about. It was considered as if, you could not sell your company. It was like the family jewel at some point. So I think those two changes, one, the fact that there's been a lot more the movement away from physical assets towards actual financial assets and the creation, and the ecosystem that's provided the ability for families and businesses to actually create financial liquidity. I think these are two which are really driving the entire wealth management creation, wealth creation going forward, at least in the business and entrepreneurial communities.
Yeah, I mean, I think, am I audible? Yeah, so I think if you really look at, I was just reflecting upon the numbers, the two demat wallets which are there. One of them has, I think, 18 million accounts, and the other one has 16 million accounts. Correct me if I'm wrong. Actually, I'm not from this industry. I'm learning every day. But what I understand is it's a 1:3. Every unique user, unique customer has 3 demat accounts. So we're talking about hardly 10 million people who are participating in the markets. And then if I, on the other hand, look at unique people who are participating in mutual funds or non-capital markets kind of participation, and there'll be obviously overlaps. That'll be yet another 10 to 12 million people, and even the 25 lakh crore that you talked about, it's still a large percentage institutional use case in treasury. So I think firstly, we are just absolutely scratching the surface. It's just, I mean, this reminds me of travel businesses that are built in the past or payment businesses in the past. It's just absolutely super underpenetrated. And one of the reasons it's underpenetrated is because of the structure in the market. It was largely, wealth management was largely run by banks. And I think banks are conflicted to be doing wealth management because banks' biggest margin business is CASA and to lend. While and then it was only the emergence of organized wealth platforms such as yours, Soumya, which came in only over the last 10 years, and that's now, more of them are coming up and getting organized, right? I don't think wealth management can also be done by fragmented small little shops. It has to be platforms, and that's changing, right? With platforms such as yours, which has happened only over the last 10 years, and this is of course addition to the points you mentioned on people moving from real estate to financial assets. I think the other thing which is changing is this understanding that data is oil. So still now, a lot of this business is being done on Excel sheets, and hence accessibility becomes difficult. Accessibility and the democratization of information. It's just that a lot of business was done in the past by making information not easily understandable or accessible, and that's changing now. That's really one of our efforts to make it easy for customers, to make things accessible. Why shouldn't high growth private assets be made available to customers easily, right? Why should it be like a closed door topic, right? And also, and last but not the least, I think the cost structures are changing, where the market is definitely like the US or the China moving to advisory. And I feel that that's going to be absolute game changer, because the right kind of investments people are going to choose, the right kind of loans people are going to choose, and that's just going to benefit consumers in their future cash flows, because those cost benefits and those quality assets will reflect if they build their future cash flow. So I think these are the things which are changing. I think it's to sum it up, scratching the surface. A lot of wrongdoing has happened in the market, and I'm happy with players such as you of having built these advisory systems, of course, for a particular audience. And I think more of us will come in with different angles and with different needs, which will solve it. And customers are now beginning to understand that the banks cannot do this business. They should be kind of out of this business. It's just straight away conflicts. They'll just sell an insurance. The RM of a bank sells insurance, and they're just interested in CASA. So very exciting time. Anyone of all of you guys, this is going to be a massive high growth industry, and I'm personally really betting behind it.
So, Rajendra, do you share the same optimism, especially from a perspective of the audience? Here we have a very young audience just about to start their careers, 1 or 2 years. From a next couple of decades perspective, is this the industry that they can choose? Is it a safe option? Do you
I
have?
think Ashish said it very rightly in the sense that we're just scratching the surface, and clearly, I mean, we haven't really had a financial savings culture before. I mean, it's just the beginning of what we are seeing as a big long journey on this, and that's where I think things are very exciting. And not only that, in terms of the evolutionary scale, I mean, if you look at it, we are still much in infancy, and with the rapid development of technology and the fact that platforms now are much more scalable. Earlier, we didn't even have scalable models to really say that we can reach out to people. And as the data on the DMAT shows that on a 130 crore population, if you have just 1 crore DMAT accounts, that itself shows that what is the kind of penetration that we still have to do to reach out to the entire masses. And look at the key driver. The key driver is the demographics and the GDP growth. And if we continue to grow on a scale that China started in 70s, and we are just beginning to start in terms of that rapid development in terms of growth, the wealth effect. I mean, you don't even have to grow at 10 or 11%. 7% is sufficient for you to create wealth, and number of people who can be wealthy would be that much larger. So these are some of the effects, the drivers that would really take you onto a different orbit in terms of the wealth. The other third aspect is in terms of, when do people come into a asset class? It's when they see that there is a lot of transparency in that, there is a lot of price efficiency, and there is a trust built into it. And with the regulations the way they are, I mean, and really in some of the aspects we are clearly ahead of some more developed markets, and the fact that the level of opportunity that investors would see in the financial assets is much more than in the physical assets in terms of both transparency, the seamlessness in terms of transacting, and the ease and convenience. I think this is just a beginning of a big, long journey.
So Ashish, I wanted to ask you, like you've been a poster boy of success in the tech world, having started multiple businesses, successfully sold them, PayU, Redbus, Go Ibibo, and now wealth management. So what made you think about entering wealth management as your next bet?
Okay, so I won't name the wealth managers who used to manage my money, but my personal problem is what drove me. I was actually really, really pained. Right? That was the first thing. I was, when, of course, what happens is that when we are doing our business, we are really busy. We don't worry about our own money, but we kind of just, when we create liquidity, you come out, you start reflecting, start investigating, you see that you're getting shafted. And the other side is not a wealth manager, he's basically a distributor. All he wants to do is sell me a product. So I got shafted with these horrible AIFs, horrible structured products, like absolutely horrible, right? I mean, I was short of shooting the people, not your bank. Your bank was perhaps the better ones of the lot, but I don't want to name the other. I'm sure Soumya would know and Rajendra would know who I'm talking about, right? But it was just, I just got shafted. And then basically, so that was the first call, right? And second thing that I said, look, when I build businesses, I build this beautiful profit and loss statement. I build future cash flows, right? That's what I would show to my investors. Look, this is the future cash flow, that's the value, right? But I said, look, nobody does this for a customer. And you can't do this on an Excel because everything is changing, right? That's where the whole machine learning comes into being. And when I would ask people that, look, where do you pull data from? That was my question, right? Because given that I come from a tech background, I would challenge the centrums of the world, etc. Look, where do you get the data from, right? Like whether it's equity data or whatever, funds data, how do you kind of manage it? And I was shocked. It was absolutely untamed, raw. These companies have been around, right? So I realized that this is a data science problem because data is coming from these hundreds of sources and nobody's kind of storing it and making sense and putting algos on top of it. So that was the second one. Third problem I realized every quarter, whenever you've got financialized in this country, every quarter you have to run around to do your advanced taxation. And it is treacherous. So I would call up Kotak. मेरे को capital gain statement दे दो, right? It'll take them like 2-3 days to give me a capital gain statement. Then I would call up the other wealth guy. Then I would call up my bank. There would be some interest, right, because of whatever idle cash. And I would be running around in circles. And I said, look, somebody has to bring everything together, right? And I would blame my chartered accountant. You're not being able to calculate. Now that guy cannot calculate on the fly indexation. He cannot calculate on the fly the whole grandfathering. I said, look, this is a massive problem. So that's really, I mean, it was just coming from pain areas. I said, let's make this transparent. Let's not look at the value of a customer from a transaction prism, but through an advice which you would give in perpetuity. So which means the business model needs to take a shift totally. So just too many problems, and I saw too many things broken, right? This reminded me of my previous businesses, but more, right? Because there were like 5 or 6 things broken. Here, I just felt too much is broken.
Very interesting. Can relate to a lot of things that you said. Coming to Soumya and Raj, I think both of you spent a good 15-16 years in MNC banks. You were at Stanchart, you were at, I think, RBS. And then interestingly, around the same time, 2010-11, both of you decided to move out from your positions and start on your own. You started Waterfield, you started Trust Tutors. So what were the gaps that you had identified at that time? And especially for the audience here, how do they go about their career point of view as far as the industry is slated now?
So just to give a background on why did I start Waterfield. So I was sitting and heading the private bank of Stan Chart, and I think similar to Ashish, there's a lot of personal pain that you see, either from your clients or personally, and you just feel that the model is broken. And certainly where I was sitting, I was looking after a P&L, and I found that the motivation for that P&L and the relationship managers was all completely driven by the commissions that they were generating on the products that they were selling. So intrinsically, somewhere, maybe I knew, they knew, this was not the right product, but then the entire way in which the institution functions is that you're being incentivized for the revenue that you're generating, and it's directly in conflict with what the client perhaps actually needs. Uh, at the same time, what I also saw was that it was just post-Lehman, 2008 had happened. Banks actually were actually came out looking quite bad in the entire Lehman crisis, where they were taking different positions on their prop books as well as their client portfolios. And it meant that there was a lot of mistrust which had come into the industry as a result of that. And you could see that in terms of what was happening in the US, what was happening in Europe, and families, clients, very unhappy with the way the banks had been organized, and everyone was trying to move towards setting up their own family offices. So when I started reading about that and started seeing also what was happening in my previous employer, I said that no, the only way in which you can be completely without a conflict of interest is where you take yourself out of the system completely. You are a free radical, and you can then therefore find the best solution for the client no matter where it is. And it shouldn't be that I am actually sourcing a product for a client in his portfolio because it happens to be part of my approved list in Standard Chartered. There could be a great product with any other competitor institution, but if that was a great product, then it should be something that I could source for the client. So that was the genesis of how actually Waterfield started, to be that free radical, to be that on the client side. And I think I shared with some of you earlier, when I started the business, everybody said, Indians don't pay fees. And I think the narrative probably is still the same even now.
Yeah, same.
Everyone keeps asking you, how are you getting paid fees? Are you getting paid fees at all? I mean, that's the first question. Uh, but I think what I look at is the fact that today the industry is changing, where people are looking for good professionals. They are looking for timely solutions. And they are looking for honesty and integrity and transparency in the way in which that wealth is managed. So it doesn't have to be highfalutin. It actually just has to be kept very simple. But fundamentally, if you can stick to these principles and values, I think that is the expectation of the client. We've always thought the client has another expectation, but the client actually is very simple. He or she is not asking us for much. What we have to do is to be able to interpret that in the manner in which we can deliver to what the expectation is.
Yeah, Soumya said it very well in terms of the business model being broken, and you step out of it and you start. You know, principally, I think one of the reasons was that, but I would really look at a different perspective again, rather than repeating what Soumya said, is in terms of the opportunity space as well. And if you look at how wealth management started, it started as a poor cousin of a investment banking or a brokerage or a commercial banking firm. So it was never regarded as the core. But when you look at it from a client's point of view, it's his hard-earned money he has created for generations after him. He may not even be spending bulk of the money in this generation. It's actually a sweat for the future generations to enjoy. So when you look at it from a client's point of view, you really understand that, look, this requires a focused and undivided attention, and it has to be coming from an expert, and expert who is not only competent, but saying that I will give undivided attention to your portfolio. I will give you 100% attention to the client and understand your goals and then look at advising. I think that's clearly, I mean, in terms of the opportunity space. And clearly the boutiques are engaged in terms of high intensity levels with the client. It's only, I mean, it's not about product selling, it's really being agnostic to the products and looking at clients and their requirements, and that's the opportunity space. And basically, if you look at the CFA level 3 kind of a curriculum, you look at what are you going to do. You are going to draft an investment policy statement for the client, identify his goals, and that's what you write in the exam. So CFA qualification blends very well in terms of the wealth management industry itself. You need to do the right things for the client. Your code of ethics, your ethics test, etc. I think are all pointers to how well you actually handle a client and how well you advise him on his portfolio. I think these are the blends, and that's where I think from a business model perspective, we clearly said that we would, if we would encourage CFA, charter holders to join us, and if possible, incentivize them in various ways to get that qualification going, because it also enables us to demonstrate to the client that level of trust, and that's, I think, the key part. I mean, be a focused provider of the services that the client requires on the wealth perspective, and that's where I think it was put to start.
Right, interesting. So, Ashish, in fact, we were having a chat just a little while back, and you mentioned, I'm sure in having started a wealth management industry company, you would have spent a lot of time in hiring the right set of talent. So, if you can just give a perspective of the kind of talent and what are the challenges that you faced in putting a team together for your company.
Yeah, look, so first, my first focus was to bring a machine learning and a tech team and a data science team and a design team. That's what I did first in back in August 2018, which I thought initially is going to be very hard, but was not that hard. I think one, because there is a change in the technology talent. They want to work with startups. They don't want to anymore work with Infosys. They don't want to work with Microsoft. They want to create impact. So I thought that went well, and that is why we were able to actually execute much faster than what I had initially envisaged. So from an idea to execution in 6 months' time, which usually in prior world would take a year, and this included licenses and all of that stuff. Then we said that look, for a segment of users, we would need wealth managers, feet on street, almost like family office managers who will coordinate activities. That was really hard. In fact, I was, unpleasantly surprised. I was like absolutely shocked, because in my previous business, I hired 700 people feet on street to enroll hotels across the country. That was also very hard, right? And it was in a way a moat, and similar kind of workforce for the bus ticketing business, similar kind of large workforce for payments businesses. But this was like, this is still hard, by the way. And I was absolutely foxed, because the compensation levels were high, but competency levels were really bad. I'm sorry, I'm being honest about it, but I was absolutely beyond shocked, right? So then essentially we said that we should definitely get someone who's even CFA level 1 or a CA. That's the kind of talent we need to get. And we said we need to get younger talent who will invest in training. So we tied up with, I'm sure most of you would have also tied up with CIL for a curriculum besides our own training. But I thought that whole onboarding process, etc., became very hard. Perhaps it would be a competitive moat, and we are actually making it easier for them, right? Because they don't need to go back to a central office, because the advisory engine is the system. Things happen seamlessly. So I think that was very hard. The other team that we brought on board was a research and algos team from the traditional side of the industry. I thought that was pretty good. That talent pool was there. Most of the guys are CFAs, and I'm very, very impressed with that talent for some reason. And in fact, when they do even client-facing work, it's just 10 times better than a lot of the traditional bank RMs kind of thing. But we've been lucky with few very good people, especially what we realized that, these folks who are client-facing should be younger. I think for me, the other challenge is changing the mindset of some of these guys from a distributor to an advisor. You know, they keep saying kuch product betna hai, right? But they need to basically create that as, you know, as Rajendra said, that financial plan, that business plan they need to create for the customer, right? That's how they need to work with it. So yeah, so I think in this journey, and in fact, I think this talent pool is going to get disrupted, the sense I'm getting. The reason I say this is because, see, between 2014 and 18, there was a bull run. So these guys are making a lot of money because of commission structures. So even any fool could have also, because things were just on a high tide. And these guys' lifestyles change, etc. Now those commissions are coming down. So I don't think they'll be able to deliver 4 times their salary. I think those business models are dead and game over. So there's going to be a lot of disruption there, which also creates opportunities for us to sift out the right people who can transition from being distributors to advisors.
Very interesting. I think 2 points that you mentioned. I think 6 months from start to execution is fantastic. There is certainly ease of doing business somewhere.
Yeah, no, I think it's much better. Setting up a company was a little pain, which was surprising for me. But like now that MC has this very unique issue of names, etc., etc. But otherwise, everything else was very quick.
Yeah. So Soumya,
Just a little bit of perspective on what I was also seeing, which I think is quite relevant in terms of the talent. Typically, banks, the way one would be organized is you'd have the relationship managers who were the set that engaged with the client, and you had these investment counselors that supposedly were the ones who actually had the intelligence behind the portfolios. And I think that line is beginning to blur at this moment. As you're looking at newer hires today, you are looking at those people that bring the intelligence along with the emotional EQ that is required in order to engage with a client, and that is perceived to be of higher value when you're actually hiring. So what I am sensing is that in the past, it may have been good enough to have either been on one side or the other, and said it was fine to be either a great relationship manager or you could hold up with your computer and do the analytics on the portfolio. I think those lines are changing in terms of front-facing, relationship-oriented people that we're looking for. You're looking for the hard analytical skills that comes with accreditations like the CFA, and you're looking for that ability to connect with the client. That is a very, very small pool, and that is one which is very hard to find.
I think we'll have to create that pool.
Yeah,
We got to create it, I think. And the second is my motivation during those early days was because what I learned that they have this so-called book. Yeah. But then what I also learned that book is not a book, right? No one's book, right? I mean, it's like client is no one's, right? It's an open thing. So hence we had to reorient ourselves.
correct. So Rajendra, we were talking about this research report from Bank of New York, where you talked about talent and compensation. If you want to just share with the audience on that.
So this, there's this annual survey that Pershing and Bank of New York do during the Wealth Summit. And the interesting finding there, and though it's largely US centered, I'm sure that we have a similar echo here, is that for 3 years running, the biggest challenge in US is financial talent shortage. There's a huge shortage of people in the financial advisory industry. And the second biggest challenge, again, linking back to what we are discussing today, is in terms of technology. So these are the key critical challenges that were there in US for the last 3 years in succession, the top 2. And I'm sure when we look at, in India, we are not going to be any different. That the talent pool really is the biggest challenge. Recruiting people on a scale that, the opportunity demands today, I think has become, I think the biggest disruption to the growth is not in terms of the opportunity, in terms of the wealth creation that's there, that's happened to bridge that gap.
So Ashish, you were talking about technology, data sciences, artificial intelligence, and your whole model is using machine learning and AI. So if you can delve deeper into what are the efficiencies it will bring to the wealth management process or to the client in general.
Yeah, look, I mean, I think, so there are multiple parts to this. Let's first start with risk, and I was talking about it outside, right? So typically the way risk was done there was a questionnaire, and there's some 8 to 10 questions, correct, if I'm wrong?
SEBI prescribed.
Yeah, CFA prescribed, which we also have to have it, but which we now find another way. But it just is friction, and I think the answers are incorrect. So what our machine learning system does is it essentially ingests users' past liabilities behavior, loans behavior, and the way we do it is we ping all the bureaus when you're getting onboarded. We also ping the banks and we pull it. So if, I don't know if anyone has got onboarded, we are pretty new, but we onboard the person's past liabilities and loans data. The second thing is we also pull in all the past investment data, and we pull in expenses, income, behavior, credit cards, etc. And of course in a fully secure manner. And that actually is also the trust that we need to build. As the brand becomes better and better, more trust will get built. And that helps us to recommend a risk. And then we ask one question, which basically helps us to give a risk output. But that is not a static phenomena because everything is changing, and hence those weights keep changing, and that's how machine learns. So that's one thing. Second thing is our entire recommendation engine is built on our machine learning stack, which pulls in data from hundreds of sources and essentially learns on a daily basis, intersecting with this risk, right? Which I think is a very important thing, but it was trivialized in the past by asking those 8 questions. So the two intersect, and we are able to then basically recommend things to the consumer. And remember, things are changing every day. You know, the PEs of the indexes are changing, the growth rates are changing. So the machine is learning and hence is able to course correct its weights and algorithms. So that's how we essentially use it. And last but not the least is for the whole future cash flow forecasting, which I think we cannot basically do any of this on Excel. Beyond this, we use a lot of data science to do taxation. We do data science to also warehouse a lot of data, markets data, you know, companies data. Another very interesting thing we do through machine learning is probability of default. As we got into it, we learned that actually debt is not safe, but it's supposed to be very secure. You know, and when things go wrong, people are hiding, right? I mean, when that FMP thing went wrong, people were not even properly sharing what's going to happen, right? Or when, let's say, the Z problem happened, or recently DHFL happened, you know, nothing is being well communicated. And why should it be first posted on Economic Times? There's no reason. We just have the data. I mean, if we would have told our customers if we were live back in September 2018. So the probability of default for us is a very, very important feature on our platform. So I think these are, I mean, again, these are all coming from customer pain areas, right? I think the nice thing is that this business is being built not with this wearing the old world financial hat, but wearing this hat of a customer. What are his pain areas? What are his problems? So that's how we use data science and machine learning. And I think more than my previous business, right, where you could actually walk into an airport and hail an aircraft, right? You could buy an air ticket. But I think in this business where data is so fragmented, data science and machine learning is all the more important.
So Rajendra, clearly as it's coming out, the technology is becoming quite important. So do you think this as a skill set is very important for a young candidate? Is just having a finance knowledge enough? Or do you think technology or similar skills need to be also part of one's arsenal?
So let me give you an interesting example that we encountered in our professional life itself on coming to technology. So as you have observed that the advisory space is increasingly getting automated, in a sense that the reviews that we prepare or any advisory platform would prepare is increasingly getting automated. The way you aggregate the portfolios, then look at the goals and the liquidity requirements of the client, and then you make a recommendation. So this is all completely getting automated. But clearly, there is still a lack of proper perfect tool that would actually seamlessly integrate the back office with the front office functions. So when you look at that, I think technology is a very important tool, but we still haven't got a perfect answer to it. Maybe Ashish has already got the answer. We are not sure, but yes, I mean, but what we encountered in the professional space is how to do a complete automation of the review, just the review section of the investment portfolio. Now, the key thing is that the current tool that we were using clearly didn't have the provision to aggregate most of the portfolios. Now, the key thing is, do we go to a new vendor, then give that RFP, then get all the specs and identify, and it's very time consuming. Not only that, I mean, replacing your existing system, it's a cumbersome process. Now, advisory team, one of the members actually underwent a course in coding and things, and that helped us actually in collapsing the timelines and actually developing a code, maybe a rudimentary code, but at the same time it worked in a sense that automating most part of the review work. So in a sense, understanding and appreciating technology, I think, is very important. Your other question is whether the advisor himself needs to learn the code. I don't think that's anymore. I mean, with machine learning, deep learning and other things, is the machines themselves who are coding and programming. So in a sense, maybe that may not be the mandatory requirement, but really appreciating, understanding, and to a degree actually doing some part of the technology work, I think, is very helpful even in your advisory function.
So Soumya, clearly 2 of the panelists are very gung-ho about technology and what all it can do. So does people like us, the traditional wealth managers, need to worry about
think
what it has
that
in store
that
for?
traditional wealth managers have to recognize that technology is here to stay. It's a question of how you use that technology. Because if you have the technology and it makes your life simpler in order to manage a portfolio or investments, by all means, we must use it, because it means that the time we would have otherwise spent on that is then used to have a more meaningful conversation with the client on issues that technology may not be able to solve for. So for instance, let's say you have a situation where a client is going through a divorce or a job loss. I mean, these are life-changing events which can't always be addressed by an algorithm, but if the algorithm can do part of the work, which you can then get it done through that, that's great. But these are some situations which at some point only human advice can provide you, if it's estate planning, if it's creating a will, if it's succession of the business, if it's the segregation of assets. I think each of these some of these are fundamental to what a conversation as a financial planner needs to necessarily have with the families. It's a question of how much can you ease the work in terms of what technology can do for you so that you have time for this. I think what is happening, which I see in a lot of traditional wealth management firms, is that nobody is willing to invest time in a client anymore. Everybody just wants the revenue, wants the product sale, and they've disappeared.
Correct.
So if technology can solve that problem and allow the financial planner, the relationship manager, to have a more meaningful discussion, which I think, Ashish, you referred to, which you were not finding with your wealth managers, then I think technology will be the biggest boon that we can say and we must embrace as an industry.
No, I totally agree. Firstly, my view is that there are 2 kinds of audiences, customers. One is people who have wealth, which means wealth in this means they have already a P&L, a broken P&L. And then there are absolutely these millennials who want to save, right? So the 2 use cases, firstly, are completely different. And I don't feel that you can do without the advisor, because that advisor is your custodian, like your family office manager, and then he's coordinating or she's coordinating activities and counseling. All of you know of a company called Byju's, right? So Byju's, by the way, is the largest education tech company in the country. But their process, the funnel is that the parent downloads the app and puts the child's name, and then after that the counseling is done by a physical human being. And that even education, where the delivery is pretty linear, even there the counseling needs to be done, the advisory needs to be done. So the teacher is like the parallel of you guys, like the CFAs. So I think I think for the wealth management, I feel that the advisor is going to always be there. One more thing I want to say, a lot of industry folks confuse this with e-commerce business. This is not e-commerce, right? So e-commerce is a funnel, right? You go to Amazon, you search iPhone or search mobile phone. Then you get search result pages and you make a decision of 10, 20, 50,000 rupees, you check out, or you do the same thing to book a hotel on GoIbibo. But here, this is a perpetual relationship. You just don't come in and you basically buy now, right? And I think that's the mistake everybody is making. In fact, a lot of my friends who are starting off tech businesses, they're saying it's a buy now business. Let me worry about the funnel. This is not a funnel business. This is a future cash flow business.
So Soumya, clearly the way regulation has played a very important role in India to promote financial assets, and we've seen so many important developments, introduction of direct plans, reclassification of mutual fund schemes, the RIA model, and so on and so forth. So especially for the audience here who may have spent some amount of time in the wealth management industry, 5, 7 years, and they have some amount of good understanding, and maybe now we're looking at starting on their own in terms of their own practice like you have. So what is the advice that you have for them from a regulatory perspective to be on the right side of regulation, so that all these changes which have happened and which are expected to happen in future become a headwind rather than being a bother to the model?
My sense is that in India, you will have the need for both distribution and advisory. It's not one or the other. I think where the confusion in the minds of many people happens is where one same institution is actually providing both advice and distribution. And that's where I call it almost like the masquerading of distributors as advisors, which is a very dangerous situation at one level. But my sense is that ultimately, there is a market for both. I think the banks will get, if they do stay in business, will get very good at distribution. I think that is where the core competency, their core competency is going to be. I see the firms which are outside the banking purview, or more like the shadow bank or the shadow banking system, is really the one that's going to cater in many ways to the advisory model going forward. Because you cannot have a conflict of interest when you are advising a client. Today, we have so many existing institutions that have an advisory practice, but they manufacture their own products. So if you manufacture your own products and you're selling that product to a client, how are you an advisor? You are still a distributor with a conflict of interest in some sense. So I think what is important is to be able to see where does your experience and your fitment come in best? And clearly, with the kind of certifications that you have, I would think it leads more naturally into an advisory kind of role. I also think that being an advisor, you are a custodian and have a fiduciary responsibility to a client. I think that's something that, as responsible individuals, you must take up. We shouldn't shy away from it. The fact that you can actually help somebody else in the process through the learnings that you have because somebody else doesn't have the knowledge that you possess, I think that's something that each one of you, if you're looking at being a true financial advisor in the future, must take up. And I see it as the future, but I also recognize that India is one of those countries where both models will coexist. It is not one at the peril of the other, and both have to coexist. But again, one of the reasons why I started Waterfield is because there was no alternative when I started the company. Nobody was saying, pay me advisory fees. The entire industry was on distribution. And I started the company before you even had SEBI come out with an investment advisory license or mutual funds coming out with direct versus distributor plans, which I think I was also crazy. I didn't realize that the business model would get very flawed unless regulation stepped in. But fundamentally, the fact that regulation is there to support one of the two models, you can choose. And given the expertise in this room, I think it will lean towards advisory.
So, clearly wealth management and long-term relationships are all about building trust, and since you started that model right from 2011-12 kind of days, and now it's becoming very apparent that it was a very good choice that you made. So Rajendra, you were a CFA charter holder and you were anyways in this industry for a long time. The CFA, how did it help for you to be on the right side of ethics and also to convey that to clients and gain their trust? What role do you think that CFA played in that journey?
So we started our journey as an entrepreneur, I think, around similar times, and then you need to look at basically how do you engage a client who is already wealthy. I mean, that's our model, to go and reach out to HNI and ultra HNI. We were not in the distribution space or in the retail space. Is how do you give a commitment to a client who is already being managed by others and demonstrate that you are serious about this profession. I think that's one aspect. So we created, several levels and levers, and CFA incidentally was one of it. But I would just go through some of these so that to really help you appreciate the model. And as Soumya, time and again pointed out about the conflict of interest and how do you negate and obviously, mitigate to the extent possible. So we felt that one of the things was that wealth management was a poor cousin. So hence it was not, from a client point of view, I think he has not been treated the way he should be treated and his money given respect to. And the other one is in terms of, how do you ensure that there is an objectivity in terms of the advice that you give. So we created something called, I think, and that's still fairly unique to the industry, is an independent advisory board. So advisory board, that's not just a name lending exercise that it's usually reduced to, but actually active in terms of supporting the advisory team to give the right advice to the clients. Look at what kind of portfolios and what kind of products to be boarded, and not just look at products from a revenue standpoint and use the products as a revenue filler gap. I think that's the key thing. I mean, identify that you are having the right products irrespective of the fact that they don't pay you well, and irrespective of the fact that you may not be making much money on the products, but these are extremely relevant to the client. So in that sense, I think the advisory board helps us, and advisory board also helps in terms of going deeper in terms of the governance aspects of the wealth management as well. So helps in terms of the sustainability and creating the right ecosystem for the client. The second one is in terms of actually, while of course, with increasing competency levels in the industry, the blur between advice and relationship managers are getting blurred, but still at the front end, the relationship manager is a producer and he is tasked with the revenues. So how do you then ensure that the advisor advice is being given right? So in that sense, ensure that the advisory team is responsible and not given any revenue targets. They would look at the goals and the deviation from the goals rather than the revenue target. So separate the advisory and relationship manager, and it's not enough to separate the advisory and the relationship manager, but also have a separate product team, because advice should be independent of the products that you have. So and it should be independent of the products that are there on the stable. I think these are some of the aspects, and CFA by itself is a natural qualification that would come in, because you already recognize that ethics are very important, and in terms of the priority that you lead to, it's the clients that come in first, then the firm, then it's you. So when you look at that priority, and in terms of the priority of transactions that you do, you give us clear rationale for your investment decisions, document it. I think these are some very clear elements of CFA that are integral to the wealth management industry, and are required to run a successful wealth management firm. So that's.
So we have now less than 10 minutes, so we'll now move to the question and answer session. We've already got plenty of those. So I have a first question which is talking about, it says that if there is serious talent crunch that you talked about, why don't you broaden the talent horizon and look for people beyond the MBA degree? So Soumya, do you think MBA degree is very important when you go and look at hiring?
I don't look at whether they have an MBA or not. I look actually for good attitude at the end of the day, and fundamental technical skills that they would actually have. But I'm going to narrate actually an incident that my husband experienced. He was working for Mr. Ratan Tata for about 12 years in the Tata. He was with the Tata Group for 23 years and was with Mr. Tata, and he went to interview with Mr. Tata and asked him and said, Mr. Tata, I don't have an MBA degree. Do you think in any way it's going to affect my working with you or working with the Tata Group? Mr. Tata turned around and said, you don't need an MBA degree, what you need is common sense. I think if all of us started living with that a little bit more and realizing that it's not always about the degrees that you have, but it's more about the attitude and the application of those degrees and how you use them to your work life, you're going to be a lot more successful than just accumulating a string of degrees.
So Ashish, there's a question for you. They want to know that banks to stay in pure banking will throw them off from their path towards financial supermarket.
Sorry,
So you talked about banks should not be in wealth management because of the
Correct.
conflict of interest, but largely they have been more of a financial supermarket. So maybe the question is to know that do you think the banks themselves can adapt themselves? Like even the US as well, we've seen there is betterment, but you have Morgan Stanley also doing equally well. So do you think banks can adapt, or they may?
I think it will be hard because clearly there is a conflict of interest with CASA and lending. That's one. Second is, if you look at the cost structure of banks, the cost structure will never lend itself from offering that transparent and unbiased service to the customer. And hence, at the end of the day, customers will get shafted over and over again. If banks are to be offering those services. So my sense is that a lot of millennials and young people and people who are just beginning to do well, they will kind of service themselves through a lot of digital platforms. And then there are the more sophisticated customers. They are all, I think, already realizing that banks are not the right place for them to do business. So I think, what banks would perhaps, smarter banks would perhaps do is partner with platforms. That look, I have customers, let me partner with Waterfield for my premier relationships, right, as an example.
Sure.
So I think that's something which smarter banks will do. The other thing which is going to also happen from a banking perspective is, I don't know, it's not that popular yet in India, but the whole digital banking and neo-banking. So banks will always be the infrastructure. They'll be the infrastructure layer, the regulatory infrastructure layer, but there would be a lot of disruption on the front end, on the user experience, whether it is digital-only credit cards, digital-only banks, et cetera, et cetera. So that's the other thing which will happen. So the banks which embrace that with partners will win. The banks that don't will kind of be left behind.
So someone I think is already running some kind of a business in wealth management who wants to know what kind of capital does it need to get the tech part. You talked about AI and all. Is it a very capital intensive kind of a thing?
It's really the compensation costs of engineers and how you basically balance it between equity and salaries. There is a bit of capital you need to put in the beginning. It's not like, so firstly, okay, so few points I want to mention. Let's not talk about how much money, right? It really depends how much, how much can you beg, right? So even after my experience, I had to go with a begging bowl, right? So you have to go beg. But I think one thing that I would definitely want to say is that when you want to build tech, never outsource it. You got to build that competence. I think that's absolutely very, very clear. The challenge is, of course, the mindset. It is a mindset issue. It's not that even if I today's date, for example, throw $20 million at someone to say, you build some tech, 99% of the chances that that company or that individual will not be able to build because there's a mindset issue. But I would really encourage people rather than outsourcing, but outsourcing fails, right? I think in the industry, for example, there's one tech provider called Miles. I looked at them. I said, look, I don't want to do the boring stuff, which is back office and all of that stuff. Let me try and take that tech from someone. That was such a horrible tech. I hope you don't use it. I mean, it was just really, really horrible and expensive. Right. So I think the point I want to mention, rather than saying cost, and it's not very expensive either, but the point I want to mention is that try and build that competency.
So Soumya, this is relevant. Someone is wanting to know that in terms of the priority, software part of it or the analytical part of it, in the final output of the wealth management advisory, what is more important?
I think you need to fundamentally get the hygiene of data right. I think no client wants to see a portfolio in which the returns are wrong or the cost, your initial cost and market values are wrong. So, and I've seen big banks go wrong in that. So I remember we used to have enormous amount of problems on the accuracy of data. So I would say that analytics is the next level. Fundamentally, just get the data right. Even that is a massive challenge across multiple providers, whether it's AIFs, whether it is venture, whether it is structures, whether it is equities, whether it's fixed income. So many different products are there, and it's getting more, exactly, the multiple sources are just killing. So I would say just stick to the basics, even if you can get a clean portfolio out, which is accurate and timely, good enough.
But I just want to add one example. So you guys are aware of this concept of dividend getting reinvested, getting paid and then reinvested. So when I had such products, and that would always show me wrong XIRR. It was absolutely wrong, right? And one of the reasons, Soumya, was because these guys were using some horrible tech. Because you can't, I mean, at the end of the day, if you do it on Excel, you'll make mistakes. So you need to have that warehouse, which is not difficult at all, right? The basic warehouse, which I totally agree. The basic reporting needs to be right.
So we'll take this last question from Gaurang. He says that a lot of fintech engines rely on data that has privacy issues. Is an opt-in model as required by GDPR a threat to data accessibility and the fintech model?
Yep. So you want me to take?
Yeah, I mean.
No, so firstly, I think that if people think that tech has more data privacy issues, then they're thinking in the wrong manner. Because I've seen in the past people take my statements of various things, physical statements, which I think is absolutely something which can get leaked. You're sending attachments and mails, etc. That can absolutely get leaked. But when you're warehousing your own data on your dashboard, of course, you can choose to show it to your wealth advisor or not. When you're warehousing your own data, it could be any data, right? It could be transaction data, it could be your financial data, it could be your mutual fund data, AIF data, etc., etc. You're warehousing on your platform, right? It's almost like using Gmail, right? It's which is more secure than writing letters, right? So I think this is a question which actually gets asked to me: what happens to my data? And using technology, and of course you need to build firewalls, etc., is 100 times more secure than the previous world. And by the way, let me tell you about banks, right? Banks sell your data. But if you do anything, if you take a loan from the bank, there are hundreds of people who will call you for a loan top up. Your data is actually every chut in the bank can actually see your entire savings account.
It's getting leaked somewhere.
Not even leaked, everybody's reading it. And then they have targets, right? So they'll come and say insurance ले लो, ये लोन ले लो अभी आप, इस लोन को टॉप अप कर लो, ये 5 funds खरीद लो, ये बहुत प्यारा सा fund आया खरीद लो. That was the call I would get, right? It's horrible, right? So I think fintech is actually the sensible fintech, and people like us are actually SEBI RIA registered, so we got to be compliant also. So I think it's much more secure than banks in physical format.
Okay, great. So I think we had a lovely session, 1 hour full of insights coming from a lovely panelists. So I thank you again for your time and all the wisdom that you've shared with the audience here. Thank you very much.
Thanks, Gaurav, and Mr. Kalur, Soumya Rajan, and Ashish Kashyap. A big round of applause. We now have a 15-minute tea and coffee break. So KPMG presentation is going on in the Royal Ballroom, right opposite this hall. Anybody want to attend, they can go and attend.